Wednesday, May 18th, 2022, Beneco 64, home of alternative economics and contrarian views. Today, we're going to look at wealth destruction in a stagflation. Yes, it's not only the economy that stagnates, it's traditional investments. There's the old saying that those who don't learn from their history are bound to repeat it, the mistakes of history. I think it was George Santayana who said that. And of course, history tends to repeat itself, not exactly, and as some would say, it rhymes. So what we're going to do today is a very simple exercise. We're going to look at some charts of different assets from around the mid-1960s to the early 1980s. Before we start though, as we're talking about stagflation, inflation, I would say financial repression, because this is what it is. This is the governments in the West, the central banks, basically taking away your money so that they can pay off the massive amount of debt that they've had to incur. It's the old currency debasement. It's the old inflating away their debts. That's what they're doing. I wouldn't believe them when they say this is because of this and this and that we're not doing that. De facto they are. So this morning we had some economic data from the United Kingdom. We had the price data. They call it inflation. Yeah, and I'll call it inflation as well, but technically it's the consequence of all the inflation that they've created over the last 15 years or so. Yes, the creation of currency and credit out of thin air through QE, through zero rates. Now we're getting the increase in consumer prices, retail prices. We're going to look at both, and I'm going to start with the RPI because that's the more realistic, and it's probably undervalued as well because they tinker with the number. But it came out at 11.1%. So there you go. We have double-digit inflation, I would say. And with the Bank of England rate at 1%, that means you're losing more than 10%. The pound in your pocket is losing 10% of its purchasing power on an annual basis. That's another form of taxation, right? What about the CPI, which doesn't include the rise in council taxes, the rise in rents, and I heard as well the depreciation of houses, because you have to upkeep, of course, your home, and it doesn't include the increase in cost of upkeeping your home. Well, the CPI, which is what the government uses because it's always lower, to basically make its payments to taxpayers or to people who get benefits. They always use the lowest. They always want to get the best of you. They don't want to help you. Don't forget that. That came out at 9%. So that's probably also, if you really count it, if you don't tinker with it, that's in double digits as well. That's increased from 7%. And also PPI, the producer price index, that came out at 14%, and it was expected at 12.5%. So it's not going to get better. And actually on the stagflationary part, we've had car registration, which is something I don't look at very often, but it dropped by 51% in April. So maybe it's a quirk, maybe it's a seasonal thing. It's not going to get better because they're still inflating. That's what people need to understand. These numbers are the consequence of inflation. These are the rising prices, or the currency becoming worth more. the currency becoming worth less. Excuse me. And why is that? Well, because they're creating a lot of currency and credit out of thin air. They're increasing the supply, and that dilutes the value. It's the simple law of supply and demand. The more currency you create relative to real goods and real wealth, it's going to make it worth less than the real wealth, and that's what we're seeing. So I talked about earlier that history tends to repeat itself, not exactly, but it rhymes. And I'm going to look back at the stagflation of the 70s. Why am I going back to the mid 60s? Well, because I think it really started in the mid 60s, mainly because of the Vietnam War, the Great Society experiment. And in Europe, they just had to follow. They had to inflate with the US. But at the time, we were under the Bretton Woods gold exchange system. It wasn't a gold standard in the classical sense. And you could argue that we were under a relatively sound money system. So they were able to keep the lid on inflation somewhat. But with the loss of gold reserves, by the early 70s, they had to basically get rid of the gold exchange system. Nixon closed the gold window, and we went on a fiat currency system, and everything took off after that. And the inflation that begun in the 60s started to show itself in rising prices, rising commodity prices, stagnant stock market. And yes, it wasn't a great decade for investors. It wasn't a great decade for the general public, especially people in fixed incomes. But actually, I would argue that we will be lucky if we get a decade like we did, or a decade and a half that that we saw from the mid 60s to the early 80s right now. And why is that? Well, because we haven't been under a relatively sound currency system. If anything, we've been under a unhinged non-system. It's not even a monetary system. There's no money in the system. It's all funny credit and currency that's been inflated out of all proportions. And so that's why I think we'll be lucky to get that kind of scenario again. I would say it can be a lot worse. And to be honest, I don't know what it's going to look like. And as I said, if it looks like the 70s, so to speak, it will be actually a result. Of course, we could get a quick hyperinflationary collapse. That will probably save us a decade of suffering through stagflation or financial repression, because that's what they're doing during a stagflation. They're basically ripping off investors and the general public in order to make the national debt worth less, and so that they can keep going with their schemes, the powers that be. So let's look at the charts then. So I've got here the Dow Industrial Average, and started before 1965, and you can see that it went sideways all the way to the early 80s. In 1983, it started to take off, as you can see. But the Dow was pretty much between 750 and 1,000 for 15 years, so it didn't go anywhere. I tried to find an S&P chart similar to that, and I couldn't. As you can see on the left-hand side here, I've got a chart or an inflation calculator, US inflation calculator, and I did 1966 to 1983, which kind of matches this chart of the Dow. And I put $1,000 there because the Dow was at 1,000 there in 1966. So if the Dow had kept up with inflation, it should have been at 3,000 at least, and it wasn't. It was at 1,000. So you lost over 200% of your wealth if you had, let's say, maybe bought the Dow in 66 or bought a lot of stocks and held it for 15 years. Even if you dollar cost averaged, because you would have gotten 750 sometimes, maybe 1,000 sometimes, but roughly you would have lost quite a bit of your wealth there, as you can see. And I think a very important asset class to look is the bond market, because that's the source of credit and finance. So we looked at the U.S. Treasury 10-year yield, courtesy of the Federal Reserve System here of the St. Louis Fed. And you can see that starting basically in the early to mid 60s, yields kept rising. Yeah, there were ups and downs, but we went all the way up to above 15% by the early 80s. So there is no safe haven in treasuries, because when yields are going up, prices are going down. Yes, you might invest in a 10-year note in 1968 at 100, a new 10-year at 100, and you will get that 100 in 1978. But as you saw with the inflation calculator, you lose a lot as well. So you're not going to gain anything. Yes, they called investment in bonds in the 70s certificates of confiscation, and I'm afraid that's what it's going to be. It's already now in the present, because you're getting less than 2% on the 10-year gilt, and the RPI is probably more like 15 instead of 11. So you're losing a lot. And now we're going to look at commodities, and those people who have the idea that we're going to have demand destruction, and we might, because it's going to be a stagnation, and that's going to bring down inflation and is going to bring down commodities. Think again. Just look at the 60s and 70s and early 80s. And yes, rising interest rates will not stop commodities going higher, as you can see here. The CRB index, why is it relatively flat here before the early 70s? Well, I think it's because they kept a lid on that through the Bretton Woods system. They kept gold. That was the fixed price, $35 an ounce, and that affected all other commodities. Yes, even in the 60s, they had the London gold pool, which was a overt manipulation by the central banks and treasuries of the major countries to keep gold from rising, because if they hadn't intervened, gold, the Bretton Woods system would have been disbanded way before 1971-73. So that's why commodities were under check. Gold as well, of course, didn't start going up until 68, really, and 71. But as you can see, commodities had a huge run in the 70s, as you can see from the CRB index here. I couldn't get a chart just from the mid 60s to the early 80s of the CRB, and then you've got the rest of the move here in the CRB, of course. And then we've got the gold price. Again, we started at 35 in the up until 1971, and look where it ended up, almost at 900 by 1980. By that time, of course, the fiat dollar was under threat. The whole system was under threat. And the only way to save it was to tell investors, look, we'll give you a 20% return or 15% return. Come back to the paper system. And they did. And that was Paul Volcker, of course. And so I think that's where we're headed. as I said, if things are like kind of like the 1970s, and I think that would be a result, because I think it's probably going to be a lot worse, because they've abused the inflation. They've inflated so much more than they did in the 60s and 70s. It's not even funny. So to be honest, I'm not really sure what's going to happen. Yes, hyperinflation is on the cards, but we could have something that we've never seen before, and that people are going to label, and we'll have to wait for that, of course. So with that, let's quickly look at where the markets are this morning. It's 8:15 a.m. London time. We've got spot gold at 1811.60. It's down just under $4. Range has been 1817 to 1807. Silver is down 8 cents, 21.53. High's been 71 and the low 45. The Dow future is down 120 points, or 1/3%. NASDAQ is down 2/3% or 75 points. S&P is down 20 points or 0.5%. The FTSE is down 5 points, and the Euro Stoxx 50, they're down 5 points as well. To the currencies, sterling rallied really strongly yesterday, and a lot of people were asking questions. What do I think is happening here? Well, if you look at the chart of sterling, or the British pound versus the dollar, it's been melting down quite a bit in the last few weeks. So markets always well, they never go up or down in a straight line. I think it was a bit of a short covering rally, people taking profits, people that had shorted sterling. But the general trend for fiat currencies, dollar included, is a lot less purchasing power. I think that's a good way to put it, versus real things. And that includes commodities, gold and silver. And I know gold and silver have disappointed in the last couple of years, but I think it's just temporary. If you don't have the patience and you don't believe in the story, in the fundamentals, then maybe it's not for you. The euro, the pound this morning, is down almost 2/3%. So it's giving back a lot of its gains from yesterday. It's at 124.14. The euro is down 1/3 at 105.15. The dollar is down 0.2% versus the yen, 129.15. And the dollar is actually up versus the Swiss franc, 0.25% at 99.60. The dollar is up 1/3% versus the yuan at 676. The Aussie dollar is down 0.25%, around 70.00. And the dollar is up 1/8% versus the Canadian dollar at 128.25. The Kiwi dollar is unchanged, 63.53. Let's quickly look at the Russian ruble. Can't forget the ruble. Russian ruble is trading around 65, 66. So the dollar's picked up a little bit versus the ruble. Ruble's trading in a quite volatile fashion, because the low today has been 62. To the commodities, which of course I think are a very important asset class in the stagflation, especially to have some of. WTI crude is up 1%, 110.87. Brent crude is up 2/3%, 111.41. High grade copper is down 7/8% at 420. And US nat gas is down 1.2% at 825. To finish off the bond market, the US 10-year yield is unchanged overnight. It's at 297. And I'll quickly look at the 10-year gilt yield. I mean, it's ridiculous. It's still at 186, and it's down over 1 basis point. I can bet the Bank of England has been very busy with the gilt market, buying to keep it yields low, which is really disgraceful and sickening for savers and investors, especially when we're seeing prices rising at 11%. That's what financial repression is, people. And at the same time, they keep manipulating the price of gold and silver to scare people away from real money, which is, of course, gold and silver. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.